So debt funds have been the subject of much debate for many months now, and in fact for a very long time even before that. A lot of the criticism has been fair, at least in the recent past, but a lot of the criticism has also been unfair, and much of it largely because there is still a lot of gray areas regarding the understanding of debt funds. There's still a lot of ignorance, especially on the duration side. Given the recent credit events, a lot of us have had to speed read and make ourselves familiar with credit risk and debt funds, but a lot of us still need to catch up on the duration side. How do things function over there? Which kind of funds work well with each other? Which kind of fund is suited for which requirement? What's the relationship with yields? Et cetera, et cetera. So I thought that it'll be a great idea to sort of have a primer on some of these funds. And with me, I have today Rahul Pal, who's the head of fixed income at Mahindra Manulife Mutual Fund, and KIRTAN Shah of SRE, who's been one of our regular guests, and he's spoken to us very, very often about debt funds. So, gentlemen, thanks very much to both of you for joining in. Rahul, I want to first begin with you because you're really a part of the bond market, right? So one is that a lot of people have difficulty in grasping concept of duration, right? So first step, can you just give a sense of what is a duration fund? What are the kinds of duration, and how do they work with each other?
Sure. Thanks, Sumaira, for having me. So the challenge for debt funds is fundamentally the bond mathematics, which is in a sense that when yields go up, the prices go down. It doesn't come inherently very easy to understand. I guess that's a fundamental challenge. And once you override the challenge, and then you are faced with several debt funds that we have in our industry. So that kind of adds up to the cluttered thinking process. So the way we look at it is essentially, which is the duration funds, the accrual funds, and and the shorter end of the curve funds, which focus on predominantly meeting your cash needs or expenditure needs. So a duration fund, the principle is simple. It tends to make have a capital appreciation much more when you have interest rates falling because bond prices move up. So the way the regulation has classified the debt funds has been long duration funds and medium duration funds, which tend to do extremely well when you have a positive interest rate cycle. And then you have a low duration fund and other categories like ultra short term, which tend to also do well, but they are used mostly for somebody has an expenditure requirement for a 1 year, kind of a less than 1 year. People tend to use it much more than a longer duration fund. And in the midst of it is a short duration fund. Use it anyway, your choice. And what recently had come to the fore and the subject matter of all discussions was credit risk funds, and uh, they were the glamorized alpha funds, but unfortunately couldn't exactly live up to its the reputation. And I guess so. It was a hard learning, and we are coming out of it slowly but surely.
Okay, so we'll come back to this hard learning, especially what it means for the duration funds. But Keertan, first, your quick take, because I mean, I'm sure you fielded as many questions as I have on which fund is useful for which requirement, right? So now Rahul has given us some sort of a primer on where do various funds fit in. But if somebody was to construct a portfolio, right? I mean, a lot of people have spoken about what the core equity portfolio should look like. We don't speak very often about what a core debt portfolio should look like, right? So, how do you stack these up, because there are quite a few which will have overlapping maturities, right? Even in duration. I mean, for example, like say liquid money market. I mean, it almost seems that, or even overnight for that matter, that they could all be overlapped with each other, right? So how do you construct a debt portfolio?
So, Sumaira, I think we try and keep it very simple. So, there are two things that I like to highlight for retail investors to understand how can they actually make a portfolio on the debt side of their investments. Look, primarily, I would like to believe that all investors should first try and understand their risk profiles, right? So, there can be somebody who's conservative, there can be somebody who's moderate, and then there can be somebody who's an aggressive investor. Now, broadly speaking, and this may change while we talk to some individuals, but at a broader level, somebody who's conservative would generally want to have 80% of the investments on the debt side. Somebody who's moderate would want to have 50% of the investments on the debt side. And somebody who's aggressive would still might want to have 20% on the debt side. Now, taking a cue of, let's say, somebody who's conservative, has 100 rupees to invest, and 80 rupees of that has to get deployed to debt. Now, the biggest problem that most retail investors that I encounter while I work with them is that this 80% money that they intend to invest on the debt side of the investing is generally deposited in 2 or 3 deposits, which leads to a lot of concentration and or if a default risk in the future. So what we generally do at our end is this 80% of the debt portfolio that needs to get allocated to debt is further bifurcated into 3 buckets. So the first bucket is something called as the liquidity portfolio. The second bucket is something called as the core portfolio. And the third bucket is something called as the tactical portfolio. Now what happens is the liquidity portfolio is the portfolio which we would want to keep aside for any emergency requirements. So let's say if 80% of the money has to get deployed to debt, 10% of this 80, which is 8 rupees, can get deployed into overnight funds or liquid funds, by which the immediate requirement for any necessary or immediate things that might come up can be taken care of through this liquidity portfolio. Core portfolio is where we believe 70% of your debt allocation should happen. So if 80 rupees has to get invested in debt, 56 rupees, which is 70%, has to get invested in the core portfolio. Now, what can be a core portfolio for somebody who's a conservative investor? Now, a core portfolio can be funds like an ultra short, low duration, money market, or short-term debt funds, where the credit as well as the duration risk is generally expected to be on the lower side. And that is where 70% of the investments for somebody who's a conservative investor can be technically deployed. And the remaining 20%, which is 16 rupees, 20% of 80 rupees, 16 rupees can get allocated to tactical bets, which the investor can take with the help of somebody who understands whether or not interest rates are moving, so they can take duration bets accordingly. Or probably if credit risk is worth taking, then they can take slight credit risk. So 20% can be invested in that tactical portfolio by which a slight alpha can be generated. And that is how I believe somebody who's a conservative investor can actually go ahead and bucket investments. And similarly, you can have a moderate portfolio and an aggressive portfolio where the funds might change in the core portfolio, but more or less the tactical portfolio and the liquidity portfolio stays the same.
Okay, fair enough. That's a good point. Rahul, now that we know a little bit about how the funds are structured themselves and how they work with each other, I wanted to ask you, what is the opportunity now, given the surge that we've seen in the bond yields, and we've seen the Reserve Bank come out with OMOs. What does this mean for a retail investor, going forward? Which is the bucket of funds that's going to do well? And should retail investors even be bothering with these headlines? I mean, should they be looking to play this interest rate cycle, or like Kirtan said, find your risk appetite and, do the allocation accordingly?
Sure. So while I broadly agree with what Kirtan says, the way The markets at this moment are, I think our bias would be predominantly towards the shorter end, that is short term funds, and lower than that. You see, there's a narrative, and that's a consensus, is the fact that you have a normalization year, and a normalization year means a normalization of several things, including interest rates. And we can't be ignorant, or we have to be cognizant of the fact that normalization can lead to a gradual uptick in yields. And and I'm avoiding the phrase having said that, and hence, if you are assuming a normalization of yields, one cannot afford to be in the longer end funds. That is, people should be careful about it unless and until they want it to be there for the longer term. But at this moment, in a normalization phase with a bit of a commodity uptick across, uh, our bias would at this moment be towards the short term funds and lower than that. That's what our funds thinking is at this moment.
Is that why you have chosen to debut a short-term fund?
Uh, that was one of the reasons, but the other reason was always a product offering. There's a market out there close to 160 lakh, 1 lakh 60,000 crores, and there's a substantial investor interest and an appetite for short-term funds. So we chose to be there.
Okay. We'll talk about the fund a little bit more because I have some more questions. But before that, Kirtan, I know you've been very actively, talking about, or rather explaining this whole concept of, what these rising yields mean for investors. So if I can just ask for your indulgence a little bit on, how should a retail investor understand this? I mean, and should they even bother? I mean, should they not just go with the allocation like you have said?
So Sumaira, of course, I would, as a retail investor, suggest everybody to stick to their allocation. But just because we are having this discussion and it's always good for retail investors to know how things work, I think to put in perspective of how yields work in very simple layman understanding is, imagine you've invested in a fixed deposit, okay? And today you locked yourself in for 3 years in an SBI fixed deposit, which pays you 5.5%. Right? Now, 6 months later, because yields or interest rates in the markets have moved up, the same fixed deposit which paid you 5.5 6 months back now pays you 6.5, right? If you intend to buy a new fixed deposit. So the new fixed deposit pays you 6.5, but the old deposit that you locked yourself in pays you 5.5, which means that while you locked yourself in at 5.5 for 3 years, even when interest rates keep rising in the market, you still keep receiving that lower 5.5 that you locked yourself in some time back. Now, this is exactly how bond markets work. Imagine you locking yourself in a bond at 5.5%, and then suddenly bonds in the market keep moving up in interest rate, and the same bond in the future, a new bond issuance, pays you much higher than what you locked yourself in at. Now, that is exactly where the older bond that you locked yourself in at lower interest rates or lower coupons will lose the demand in the market, and hence that bond will start falling in price, which is why it is said that when you lock yourself in at a lower coupon or an interest rate and then interest rates or yield rise in the market, this bond which has lower coupons will suddenly have lower demand in the market and the price will fall. That's exactly what Rahul was trying to explain, that when yields in the market go up, the value of this bond falls in the market. And which is exactly why, if you look at how the market is currently poised, and taking a cue from even what Rahul said, the consensus expectation is that in the next 6 months, 9 months, probably you will see rates moving up. Yields have already started moving up. And which is why you should position yourself at the lower end of the curve today, because that's the right positioning in my opinion as well.
Okay, so then let's go back once again to the Mahindra Manulife short-term fund, which they're launching. And the NFO is on till the 16th of February. So Rahul, if you can explain a little bit about what is the investment philosophy, what is the positioning of the fund? Because, you will be entering a category that is already quite crowded and quite popular. So what will be the differentiator?
As the regulatory definition of a short-term fund is the fact that it will invest in securities with a portfolio having a Macaulay duration of between 1 to 3 years. It is The portfolio is agnostic to credit rating because you have other funds which are defined by a credit rating. This portfolio is agnostic to credit rating. So our focus is definitely on quality of the securities, a quality portfolio which ensures good liquidity enough, and risk management practices which behove the best of its kind. Risk management beyond the credit risk, we talk about liquidity risk management, we talk about the liability risk management, which we feel is a very core part of a liquidity risk management. And uh, and the attempt is to ensure that we be credible, transparent, and perform with the risk adjusted returns which investors expect, and that would be the core architecture of our fund management.
Okay, Rahul, this point that you made about the short-term fund being agnostic to credit rating, I want to just talk about it a little bit more because, while I agree that SEBI has not defined it as such, but we've already seen short-term funds pay the price of taking on credit risk, right? I know it is not a criteria, and before I ask my question, I want to just explain to people who are watching that what I mean by credit criteria is that SEBI has laid down these guidelines. Like, for example, in a credit risk fund, they say that minimum 65% should be in AA and below, right? So that is a criteria that every credit risk fund has to follow. Likewise, for say a corporate bond fund, there is a criteria that minimum 80% should be in AAA. So like that, like Rahul mentioned, the Macaulay duration of the short-term fund should be between 1 to 3 years. So that is the criteria with which the duration funds are defined by SEBI. But even if you're taking a bond of a company and you club the bonds together and you get that Macaulay duration of between 1 to 3 years, each company also has a credit rating, right? So therefore, Rahul, is that something that you will be also seriously looking at?
Yes. So thank you, Sumaira. I think that that's very critical to every discussion that we have now. One is, let me just go through the genesis of. Let me try to pull the threads together for what has happened in the past, and let me try to let the threads weave together to give you the tapestry that I hope I can weave. One is, somewhere in 3 or 4 years ago, the then finance minister had introduced the fact that the debt taxation moves from 1 to 3 year. I think that was very critical. It was initially thought that it would be a deterrence for investments in debt funds, but it turned out to be the biggest flow of patients' capital. And so, if you start measuring the growth of debt funds and the stability in the patient's capital, and you will find that there was significant growth in the debt funds after that. And from there on started an onward march towards mutual funds being a very dominant part of the entire corporate bond portfolio. So from a 10% of the outstanding corporate bonds outstanding, we moved close to 20 to 25% at the peak. Now, fundamentally, in an open-ended architecture, if you have such a large part of, and when I mean open-ended architecture, I mean open-ended mutual funds, and if you have a large part, or you suddenly become a large and a dominant part of a corporate bond issuance, which comes with a natural illiquidity, there may be potential challenges, and that's what we experienced. Also, the fact that somewhere down, I believe patience capital built its own sense of probably a bit more risk taking, probably a bit more of, a bit more probably complacency. So we were thankfully in our funds, we never had a challenge in the last 5 years. Before we had set up the fund, we had done a bit of a homework. We had stitched together something called the res guard process, wherein we had looked at past events to give us an investment checklist as to what to look for, and there was an objective assessment as to what we had tried to figure out. It was a part of a, I mean, when you talk about corporate governance, how do you put it objectively? That was our main stuff. And then you have to go beyond accounting norms. I mean, we had there are some traditional indicators that we have incorporated in our in our risk card process. And more importantly, I guess somewhere in this humdrum, what is lost is the behavioral aspect. I mean, people talk about the behavioral aspect a lot in equity, but somewhere gets lost in translation in the debt markets. So there are two kinds of behavior that we tried to inculcate within the team. One is a behavior of what I call skepticism, a healthy skepticism. You question everything which is out there. You question an extreme optimism, you question an extreme pessimism. And B is there's a behavior called there's a nice English phrase called acritic, which means the fact that you succumb despite to the best of your options, and you know that you're not supposed to do that, and yet you succumb to it. This is something that we have tried to avoid. It's a very difficult behavior. You succumb to an acritic behavior. We have managed to avoid that till date. And I guess that's one, and hence we are building up a process. We're also taking best input from from what the global partners do to us, and so those insights help us in further looking through the processes and ensuring that no great credit events happen, or we are absolutely safe in terms of our credit process, and ensure the only risk that should emanate from the portfolio is the duration risk and nothing more.
Fair enough, and that's, not having any toxic. But Kirtan, a little bit more, indulgence on concepts like Macaulay duration. I mean, since we are talking about duration funds, if you can explain some of the key concepts that come with these funds, which will help people actually in making better investment decisions.
So Sumaira, while we talk about durations, there are two types of duration. It'll become slightly difficult, but I'll try my level best to make it simpler for everybody. So one is called the Macaulay's duration that even Rahul spoke about. And then you have something called as a modified duration. Now, if you look at the SEBI guidelines, SEBI has categorized funds keeping three objectives in mind. So out of the 16 total categories that you have, some categories are defined by which credit papers can the funds invest in, like the one that you pointed out, which is the credit risk fund. Similarly, you have banking PSU fund, you have gilt funds. Those are defined by the fund investing in credit. The second is decided by the fund investing depending on average maturity. So if you look at an overnight fund or a money market fund or even a liquid fund, the guideline says that you have to invest in a pattern where the maturity of the bond cannot be more than something. So in an overnight fund, maturities can't be more than 1 day. In a liquid fund, maturities can't be more than 91 days on an average, weighted average basis. The third is something called as the Macaulay's duration. What is Macaulay's duration on which the funds are categorized? In very simple term, it means the break-even point of a portfolio. So if the Macaulay's duration of a particular fund is, let's say, 1 year, what we are trying to say is that with all the coupons that the fund receives from the bonds, and let's say hypothetically, the bond has to be sold at that point, the addition of the coupons plus the value that we will get from the bond is that point where all your invested money comes back. So what I mean, that let's say if a bond is of 10-year term and the Macaulay's duration is, let's say, 7 years, it means that if I add all the coupons and if I look at the value of the bond at the end of the 7th year, roughly I will get all my invested capital back at the 7th year, which is the break-even point called the Macaulay's duration. Now this is basis which the funds are categorized by SEBI. Now investors don't have to bother about this because this is not very relevant to them. What is relevant to them is something called as modified duration, which is always mentioned on the fact sheet of the fund. What is modified duration? Modified duration is the sensitivity of the bonds of the fund's portfolio to interest rates. Now we understood when interest rate moves up, the bond fund goes down. When interest rate goes down, bond fund goes up. But the question here is by how much? So I'll give you two examples. Let's say there is fund A, which has a modified duration of 2 years. And then there is fund B, which has modified duration of 5 years. If interest rates in the market have to go up by 1%, we know that the funds will fall. But the fund will fall by how much? So fund A, which has modified duration of 2 years, will fall by 2%. Right? How do you get that? You multiply the modified duration with the change in interest rate. So interest rate moved up by 1%, fund had 2% modified duration, 2 years of modified duration. So 1 into 2, the fund will fall by 2%. But fund B, which has 5 years of modified duration, will fall by 5%. 1% change in interest rate multiplied by the modified duration of the fund. And which is why in the current situation, while we are talking about that interest rates or yields are expected to go up, it is prudent to stay invested at the lower end of the curve or funds which have lower modified duration, because change in interest rates going up will have a lesser impact on the fund. I hope that answers your question, Sumaira.
Yes, it does. And the other big topic, and let me toss it over to Rahul for that, is how should retail investors be looking at returns from debt funds? Or is that not the metric to track?
While we think it's an interesting metrics to track from an overall perspective, and if you look at the last 10 years, or the last 13 years, and if you look through the cycles that the interest rates have gone through, and then you start measuring the indices. I mean, there are some relevant indices turns out the fixed income funds also have indices. So if you measure the relevant indices, I mean, gilt or bond short-term bond indices or the long-term bond indices, you'll find nice range of returns which come in through the indices. So we have done a bit of a study ourselves, which found out that from a 2008 to a 2021, a short-term bond index would probably, it tends to be in a 3-year return tends to be in the range of 6 to 10%. So those kind of studies have been done, and in fact, interesting studies are there also if you have to measure SIPs. I mean, in India, SIPs unfortunately are mostly in equities. People do not talk about in debt, but then volatility adjusted SIP returns are also very healthy in debt. I mean, we need to put a bit of a math to it, but internally we have figured out that there's a very interesting math to the entire SIP on debt. I mean, we talk about SIP on equity indices. I think it's time that we start capturing SIP on debt indices. It can be a potential risk-adjusted good volatility outperformer. That's the way I would like to leave it here at this moment.
Rahul, it's interesting. Why hasn't this SIP in debt funds picked up? And which is the way, if an investor was to begin today, how would you recommend they go about it?
At this moment, while the dominant narrative has been lump sum in debt, and SIP in the other asset class and equity, it's a matter of time that we start, flipping the narratives, and I guess it will come someday. But at this moment, I would go by the fact that it's a very it's a healthy thing to also start looking at SIPs in debt also, and ride the volatility, because there is an element of volatility. A lump sum they get you on the wrong footing in debt also, and if you want to skip that, please do look at SIP also. They form a very interesting combination also, along with an equity SIP.
Kirtan, do you get inquiries from clients about SIPs and debt funds?
I think, Sumaira, it's the other way around. And I'll tell you why do I say that. Is because, look, everybody today in the industry, if the client is going directly or the client is going through a distributor, is trying to project debt funds as a replacement to a fixed deposit. And that is why this entire narrative of SIP is not picking up. Is because while the entire narrative is debt funds as a replacement to a fixed deposit, and that's the same language everybody talks, including the retail investor, distributors, and media. The investor community also is looking at debt as a replacement to fixed deposits, and which is why the only discussion that happens in debt funds is lump sum. And I think it's the job that you and I together will have to make sure that is spread across, is because if you look at debt has some volatility. And like Rahul rightly said, that if you've not chosen the right fund to invest in, you will see and encounter some volatility. And while debt funds have volatility, which is not very commonly discussed on platforms, lump sum investment is something that is always preached. But like you rightly said, I think it's the mediator or the media or the fund house job to, kind of educate investors, saying that there is volatility in debt. Of course, it is much lower than what you see in equities, but there is volatility. And hence, SIP can be a very interesting route to invest or channelize your funds to debt. So do we get inquiries? Answer is no. But I think it is my job to educate them that, because there is volatility, SIP is something that they should also look at in debt like they look at in equities as well.
Yeah, it's the same thing with ELSS, right? I mean, it's just so fixed in people's minds that January mein karna hai that, we don't even think that you could do an SIP in it. Okay, fair point. Rahul, the other thing is, one, of course, remains that people need to be educated on this whole concept that, even debt funds can have SIPs. The other place, which I've noticed, where a lot of investor interest is lacking, or, maybe it's not been spoken about enough, is that not a lot of people are reading fact sheets, right? And especially for debt funds, that becomes quite important. And since you're the guy who prepares the fact sheet, if you could give us a sense of what investors should be looking at. I mean, what are the top 4 or 5 things that you must see every month?
Okay. So I think one of the more interesting and relevant things now has happened in the riskometer,
Yes.
and how frequently it gets changed. I mean, so now it's mostly the driver of a riskometer is today predominantly the liquidity risk in the debt portfolios, and it may change month on month. So that's something which has come new, but forms a very interesting way of looking at peer comparison. So I think that's number one in your mind, and then of course you have the YTMs and the modified durations, which you can look at the portfolio. But I think today riskometer can give a good sense of the quality of the underlying liquidity of the portfolio, not so much as the solvency, but the liquidity definitely.
Okay, so that's true actually, because earlier it used to be a predefined riskometer for each category. Now what Rahul is saying, and what has come into effect from the 1st of January, is that even within a category, different funds can have different risk levels, right? And that risk level is dependent on the kind of risk that each of these funds will be taking. So within say the broad category of say a short-term debt fund, there would be 3, 4, 5 funds, but each may have a different rating. And for example, Rahul's new fund, which is the Mahindra Manulife short-term fund, has a rating of moderate, and this is a rating that will change depending on what the underlying investment is, and it has a combination of several other things, like what is the liquidity, etc., like Rahul mentioned. Kirtan, the other point that Rahul raised was this, YTM. Now, this is another concept that investors sometimes have not understood properly or wrongly understood. So can you set the record straight?
So Sumaira, I think there are 2 things that I would like to highlight that investors should definitely look at, apart from what Rahul has already covered, is
Sure.
While they look at the fact sheet, they should look at YTM, taking a cue from you, and something called as average maturity. And again, I bring my reference back to the thought process that the retail investors have with respect to a fixed deposit. So let's say, for example, if I'm a retail investor and today if I want to do a 1-year fixed deposit, I go to the bank and I ask the bank to invest this money in a 1-year fixed deposit. I neither do it in a 6 months fixed deposit, nor do I do it in a 2-year fixed deposit, right? Exactly the same way is how I would advise investors to actually go ahead and look at debt funds as well. So what do I mean? Let's say while you open a fact sheet, you will see these two data points called YTM, and you will see something called as an average maturity. What does it mean? Let's say the YTM of the fund is 6.5%, and the average maturity is 18 months. What it ideally means is that if you hold this portfolio for 18 months, which is the average maturity, you would more or less, before expenses, end up making the YTM, which is 6.5%, which also tells you that if the average maturity of the fund is 18 months, what the fund is expecting you to stay invested is at least 18 months. So let's say, for example, there are different funds who would have different average maturities, right? So let's say a liquid fund has an average maturity of anywhere between 50 days to 90 days or 91 days, which clearly says that you should invest in this fund only if you are willing to stay invested for 50 to 90 days. Similarly, you would have an ultra short-term fund which would have an average maturity of roughly 180 days and slightly below, which clearly says that if you are looking at investing for 4 to 6 months is where you should look at investing in an ultra short-term fund. So I would rather request retail investors to look at YTM in context of an average maturity. So if you see YTM as 7%, don't expect to receive 7% unless you don't stay invested up to the average maturity of the fund. And that's something that I would sincerely suggest that retail should look at, apart from what Rahul has already covered.
Okay, Kirtan, also a word on taxation in debt funds.
So Sumaira, I think this is a huge advantage that debt mutual funds bring over most deposits that can be corporate or even bank fixed deposit. So what happens in bank fixed deposits or corporates is, let's say today an SBI fixed deposit pays you 5%, but because you are in the 30% tax bracket, what you get in hand is 3.5. 5% minus 30%. Now people typically get carried away saying that the TDS is only 10%, and which is why they believe that they only pay 10% tax, and which is not the fact. In any deposit, you are actually paying tax at the slab rate, right? So if today you invest in a fixed deposit and get 3.5% post tax, you are way off than what inflation is in the market right now. Inflation is 7%, you are getting 3.5%. You are not meeting your expenses. And that's exactly where I believe debt mutual fund plays a very interesting role in terms of taxation. So what happens in a debt mutual fund is, let's say the short-term debt fund ends up making 6% for you, right? In the same year, 3 years that you've stayed invested, right, and you've made 6%, let's say inflation was 4%. Your expenses have gone up by 4%, which means the way taxation works is the mutual fund paid you 6%, expenses went up by 4%. So ideally what you've made net is only 2%. So in mutual funds, you only get taxed on this 2%. How much do you get taxed? Even if you are in the 30% tax bracket, on this 2%, you pay 20%, which is 0.4, which means that the fund makes you 6%, you pay 0.4% as tax, and the net that you make is 5.6, right? And that's a huge advantage that I believe that investors have by investing in mutual funds. Just to close this conversation, this advantage, which is called the indexation benefit, is only got if you stay invested in the fund for more than 3 years. But if you stay invested in debt mutual funds for less than 3 years, then the taxation is equal to what the FD or the deposit taxation was, that the interest is added to your income and you are taxed at your slab rates, Sumaira.
Okay, and we're almost out of time. So Rahul, just to wrap things up, I wanted to ask you, what is the one thing that you wished more debt investors asked you? Not a lot of people ask about risk. Some have started now. Do you wish they asked a little bit more about your risk processes? What do you think they should be asking you?
Okay. Your biggest mistake? No, that opens your biggest behavioral mistake rather than actual insights. Your biggest behavioral mistake is something that everyone should look through, and that's a very common question that people should be asking, because that sets a tone for how he thinks and manages the fund. Uh, so that's what I think is predominantly an investor should ask, but that's a very difficult question to articulate for an investor. So I think the other thing which people should be asking is, how do you define the volatility in your scheme? Returns are all fine, but volatility is something which is under. We take it for granted that volatility is low in debt funds, and we aren't prepared for that. So people should ask also about more volatility. I mean, the nature of volatility in debt funds.
All right. Well, all of those points are noted, Rahul, and you can be sure that next time we'll be asking all of these questions and more. Thank you very much. Thanks, Kirtan, for joining in, and thanks to both of you for sort of making it easy for us to understand how duration works in the debt space, what's the relationship with the bond market, and how it all comes together.
Thanks, Sumaira.
Thank you,
Thank you.
Sumaira, for having me.